Hello, today is June 6th. It is a Wednesday, 9:41 a.m. Welcome to another episode of Crypto Wars, coming to you from cryptoversegold.org, providing insight on alternative assets and things. Okay, so we're looking at what's going on today, and it's kind of like the same old story, you're seeing kind of like a flat trending sideways markets and maybe some uptail in a lot of them, including cryptocurrencies, the indexes, and even gold and silver is kind of holding up pretty good, and it looks like it could actually, begin to move up. I think, whenever we see markets move, it's usually because of some sort of overflow from the major indexes, right? Or major indexes or banks or pools of investment or where majority of the wealth is held, I think, in society in general, right? And then once that starts to deplete, at least decrease, or, the demand isn't so increasing, right? And it starts to move to other sectors, it begins an overflow. And that's kind of like what we even saw in 2008, even with gold and silver too, like gold and silver had a really good tail up in 2008. People talk about how gold and silver crashed. Well, if you look at the mining stocks in 2008, they actually performed okay. Not as well as they did in 2001 when they were cheap, which is actually, strange because the price of gold was low in 2001. But the reason, I don't think the mining sector is so reliant on the price of gold as people always suspect, because people always, especially in investing, like, people are always looking at the price of gold and like, well, that is the most boring thing I've ever seen in my life, right? Because it barely moves, right? It's just a boring, it's volatile in ways, but it's not like cryptos or like a biotech stock or things like that. But, when you look at the mining sector, it's heavily reliant on the economics and the sentiment of it all. I think, I remember someone saying that sentiment is a big part of where money is moving. And that's what this all is. It moves because when it goes to one place, it leaves another, right? And that's why you see booms and busts, because that's what happens. It moves, and then people jump on the rush or the wave, and it continues to rise. And, it's kind of the natural way of things. I think people are always trying to wonder why these bubbles form or how they form or, what happens and things. I think it's also the natural way of things. I think one of the worst parts, too, about it is the housing and the way the housing is structured. Like, the whole housing market is structured based on these loans and these mortgages that have interest rates and great interest rates or whatever, right? And what they do is they encourage people to buy houses. They're like, oh, the interest rates are great right now. It's like, okay, the interest rate could be great right now, but if the house valuation is freaking way overvalued and skyrocketed and it's over the roof, and you just got married and you're excited to start your family and things like that. And I get that, and I totally get that. But I don't think that people should over leverage into their house or see it as a type of investment, right? Like, oh, we're going to put a bunch of money into this and then we're going to sell it for more, or things like that. Like, yeah, there are times to invest in real estate, but it's not. It's more of like when the market calls for it, when there's corrections like things like this, because the interest rates is all bullshit. It just encourages people to buy over-evaluated assets. And then once they do, they jump on, and then their price evaluation, their house plummets, and then they're paying these high mortgage rates, and now they're so over-leveraged that not only did they pay more and their price is worth less, you know what I mean? Like, if you just paid the amount, you're already screwed because it went down. Now you're paying more for it and it went down in value. So, it's a big cahoot system, and the reason the prices of the houses can even get so high is because they control the whole mortgage ring, It's not like you're buying with cash or you're paying, why can't people do homeowner finance? Why? Why don't they do that? It's because it's more risk, obviously. There's no risk, in doing that. But there's no risk but that's another thing for blockchain too, homeowner finance and things like that. Like, what's the difference between the bank? You're just using their software, and they just got guns behind them. That's the only difference, you know what I mean? But the thing is what I'm getting at with this is when you evaluate all this and when you rely on the banks for housing or for all this stuff and the loaning for schools, and that's another thing too. You know, how much of the stock that people are purchasing, or these crypto coins or whatever, how much is it real intrinsic value, or is it just student loans, or is it credit cards? You know, it's not even money people worked for. It's just money that was just created, you know, between the credit lines and all this BS. You know what I mean? And then you throw, like, you know, the mining. I don't know, not necessarily Bitcoin mining and shit. That's more like economically sound and things for it, but you know, in the aspect of, you know, just like delusional economics, like fantastical daydreaming. Yeah, we can just rule. We can just proclaim ourselves as God and sit here and print as much you know, wealth as we want. So you can't do that, no, because wealth is not. It's not something that is printed. It's something that is made or created through work and time, right? That's why proof of work is like that. Proof of work, whatever. But yeah. So basically, what I'm getting at with this is you're going to see that in 2008, when there was the recession, it happened right around this time of year, right around I think it was May and June. You know, things started to turn over the hill, and it started to, you know, the roller coaster ride started to go down. You know what I mean? And that's what this thing is, man. I mean, the way these indexes move, it's like a slow roller coaster going up, and then you crash down to the bottom, and there's no bottom. Like, there's no up, I should say. There's no up after that, right? It's just an oblivion, and that's it. Because with these indexes, man, it's not proper investment, and the markets are all so rigged. It's absurd. It's absurd. You understand? You got market makers on these things all day that are just pinging the local financial investor and just kind of like getting, you know, whatever buy order they're putting in, you know, because when that happens and they put in those buy orders and they have them all lined up for you, they're selling you thin air. You know what I'm saying? And it's easy because the corporations, I always say this, the corporations, the SEC, and the financial institutions and financial advisory firms are all interconnected, okay? Because the SEC regulates which index or which assets people can purchase through their financial advisor, and the corporations work with the SEC to be those stocks. So when you look at it this way, the SEC says to the entire general public, if you want to work with a financial advisor, you only can buy these corporate stocks. So guess what? Of course the corporate stocks are skyrocketing because it's the only thing that people can buy. I mean, yeah. And then every other resource, or then the resource sectors are dying. They have like blood flowing out of them. You know what I mean? They're holding on to wounds, crawling. You got hedge funds that didn't know that. You know what I mean? This whole thing is brewing to be something. I don't know. It'll be interesting. Maybe I'm a little dramatic. All right. Have a good day. Peace.